Hey everyone, welcome back to your Money Life podcast, episode 336 of the pod. So do me a favor where you're listening, like, subscribe, five-star rate, and review this podcast. This is an every week podcast. New and old listeners, make sure you do that. Let's jump in to the market update of the week and talk about what has been, again, a quieter summer. It's going to be usually around this time we see quiet in the trading, not a lot of news. There are some numbers that we should talk about with in regards to inflation, wholesale inflation, all those different things. So we'll touch on that a little bit. But let's dive into the chart and show a little bit of what we're seeing so far in the past week or so of trading. So past 5 days, we're a bit up, maybe close to 0.5% up on appreciation. Again, the volatility in the past 5 days has been somewhat a little bit more volatile than the rest of, let's say, what we've seen recently. So that volatility is there. Past month, a little bit up, higher than flat as far as appreciation. 6 months, really strong gains. And year to date, still up over 10% year to date. They would have told you it wouldn't happen, couldn't happen, but still strong, up over 10% year to date. A lot of this is driven by tech. A lot of this is driven by semiconductors. A lot of this is driven by the big companies siphoning and capturing all of the value, as well as some smaller niche companies that are looking to capture value. So that's the big update. Let's see what the market and some of the themes in the market. Yeah, so on semiconductor, they did decline by 4.6% in increases in spending, which they did have a better than expected second quarter report. We have Van Eck semiconductor ETF that also slid. So some of the semiconductors did pull off after they've had a heck of a run, right? If you look at SMH, and let's look at actually SMH, which is the Van Eck semiconductor ETF. Past 6 months, it's up 46%, folks. So a pullback is expected. Year to date, it's up 60%. So semiconductors are flying high right now, maybe a little bit too high, as you can see, because the market's saying, all right, let's pull some of that back. Let's rein some of that in because they've been having a heck of a story. Look at the year chart. Look at the 5 year chart. These are some numbers that you don't see often. But semiconductors, chips, the power AI, all these different things are going to be needed, so that's to be expected. United Healthcare shares rose more than 7%. They had better than expected results. We talked about Taiwan Semiconductor already. Retail sales. So retail sales are up, jobless claims are down. So is the economy doing well? Well, let's look into it. The retail sales rose in line with expectations, while jobless claims fell, and factory activity in the Philadelphia area hit a nearly 5 year high. Interesting. What's going on with factories in Philadelphia? The advanced estimate for sales in retail and food services increased 0.2%. This is according to the Commerce Department. The numbers that are adjusted for seasonality but not inflation. This was in line with estimates. Initial unemployment claims fell to a seasonally adjusted 208,000 for the week ended July 11, down 8,000 from the prior period. So we're seeing a little bit more activity in the market, in the economy, that's showing we're still strong. U.S. Treasury yields, we'll talk about those in a bit or later. So there's not much else as a theme. Again, usually it's quiet during these months, in the summer months, especially July. So that's all you're getting on the stock reporting economy side. Let's dive into specific news. Netflix is had a tough go of it recently. Netflix second quarter results are coming out today. If you're listening today, insiders are expecting slowing revenue and ad sales growth. And Reuters is reporting investors will be looking for clues that the streaming giant has a plan for more buzzy and binge worthy content. So they're saying their content's falling off. Analysts are expecting a 13.6% revenue increase, the slowest in 4 quarters. Its advertising business, vital for growth, it's slowing too. Let's look at the chart and see what is going on with our guys over at Netflix. Let's see. So Netflix chart hasn't been doing that great. This is coming after they were supposed to buy, they bid in that deal, the Paramount HBO, they bid for HBO's Warner Discovery, their assets and their content, didn't win that bid, backed out. And since then, the stock hasn't been doing that great, right? And maybe this is an opportunity for folks because I still believe their content is king. Their original content usually is king. They kind of lost track of that when they were chasing to purchase in organic. in organic growth by purchasing Warner Discovery, right? And their library of content. But now they need to get back to doing their secret sauce of creating great content. So down 40% year to over the past year to date down 20%, which is opposite of what the market's doing, obviously. So that's something that is going to be happening. Their earnings report is going to be really crucial, so people can see how is subscriptions, how is advertising growth, how is their content slate coming up for the back half of the year. Those things are going to be crucial to see. I do think they make a recovery. I do think they bounce back. So this could be opportunities for folks. Looking at sports, Argentina, I watched this full match, Argentina, England. Again, I picked the winners. I didn't say it. Now, of course, it's easy for me to say I picked the winners after it's materialized, but I did have Spain and I did have Argentina, and they both came out victorious. I just picked them to advance, didn't pick them via the 90 minutes, picked them to advance, and they did. So Argentina, what a match that was. In the final seconds, they were trailing 1-0 with 5 minutes left. They rallied for 2 goals to advance. Sunday versus Spain. I'm saying this now. I think I'm going Spain. I think I'm going Spain, but we'll see. We'll see which one I actually bet on in a bit. United Health smashed earnings going back to business. United Health Group, they raised their profit outlook for the year. They had a blockbuster earnings. The country's largest private insurer now says it expects 2026 adjusted earnings per share to be $19.50 to $20, up from $18.25. So they're really giving money back to shareholders, or increasing appreciation for shareholders, I should say. So they had a in stellar quarter themselves. We talked about some semiconductors. But let's look at TSMC. They announced a fresh $100 billion investment in U.S. operations. So Taiwan Semiconductor, we talked about. On Thursday, they announced a new $100 billion investment into U.S. operations on top of the $165 billion they had already committed. So this TSMC, Taiwan Semiconductor, it's a chip making giant. They plan to expand their footprint in Arizona, adding 4 new chip fabricating factories. The Phoenix site already houses 6 semiconductor labs to advance chip. So that's pretty interesting. So that's a big news from them. Any other news? Let's see if there was anything else that we want to touch on. Nothing big, I would say. Nothing, again, quiet times. Quiet, really quiet times here. But let's jump into something on the roundtable that's a refresher from what we've talked about before. If you think about under the financial advisor umbrella, there's many people that call themselves advisors and different things, but let's look at the actual specific meaning of the term, right? So financial coaches are not actually fiduciary advisors. They're not regulated. They can't operate and give actionable tax advice, investment advice, because they operate under fewer legal standards because they're not regulated. They're not regulated. I mean, they can do less. And thus, the fact that they're not regulated doesn't allow them to operate and do certain things, right? They can advise sometimes, provide guidance, but they can't execute and invest. They can't even actually do those things. Again, there's no regulatory ability for them to do so, no direct alignment with you, right? They're going to get paid no matter what. You just show up to the call, they're going to get paid no matter what. And it leaves you. So there's two types of people in life. There's people that like try to do everything themselves, and there's people that don't want to do everything themselves. And it leaves you, if you work with a financial coach, in control of doing everything yourself. Now let's look at a traditional broker. Their sales is the most important because a broker is literally in the name. They broker deals. So what they have to do here is prioritize products that make them a larger commission, right? Maybe it's just wholesale insurance, some sort of lifetime insurance, any of those sort of things a broker is really going to push because that's going to be most optimal for them as far as their commission check at the end of the quarter. They focus on the products and sales. I mean, if you ever spoke to a insurance provider, broker, or like any of those, what's Edward Jones or any of those places, they want to sell their insurance first because that's what money in the bank. They're going to see that check right away, especially if you have limited assets to invest. They don't even care about creating a portfolio for you to invest because they care more about getting that commission check. People don't even know how it works. Like it could be opaque. Like, oh, I just get life insurance. I'm paying this premium. I pay maybe initial amount and then it's premium. And how does that work? How do you get like they don't people can anyone explain that? Like that's actually really, opaque, hard to understand. And and really, really interesting. And there is so much more underneath that as well. Now, where New Street sits, my firm, who's opened over 480 households across the country and tens of millions of dollars that are investing for retirement and other medium or long-term goals, is a fiduciary. As a Series 65, we are a fiduciary. So a legal duty of care and a duty of loyalty. I don't have any products to sell at all, right? A legal duty of care and legal duty of loyalty. As my clients do well, I do well. We've done well and our clients have done well, and that's why we continue. It's a chicken and the egg thing. That's why we've continued to do well, right? And so that's a super big thing. You want the incentives to be aligned in those areas. Transparent. Everyone we've had, I could even look. We've had 140 prospective calls this year so far, maybe 130 clear, and I'm able to clearly explain what's going on. In fact, right now we're offering for creatives and some sort of people free complimentary financial planning, which is clear and easy to disseminate, clear and easy for me to tell someone to articulate. And then, of course, institutional security. So we actually held our assets for our clients at Charles Schwab, one of the bigger broker custodians in the country, in the world. World class institutional custodian. So third party identification, asset protection, 24/7 portal access makes this our life easier for our over 480 plus clients. And so understanding that is super important. Don't get mixed up with like wellness coaches and things of that nature because they're not really regulated to do what they are, besides base level stuff that anyone can Google because they can't understand you and implement any plans directly for you, right? And so that's something to really, really understand or note when we start hearing these other pitches, right? So make sure in this roundtable, folks, you disseminate that information, you pass that information. If there's someone out there that actually needs fiduciary advice, make sure they reach out to New Street because we'll be able to help them. Folks, that's it. We will speak to you again next week.